Imagine opening your banking app on a random Tuesday morning and seeing a number that used to make your stomach drop turn into a zero, not almost paid off, not just one more year. Zero. That's exactly what happened to a 25-year-old we're going to call Maya. Not her real name, but her real story. She made the final payment on $80,000 in student loan debt. $80,000. Gone. In under 4 years. Today, we're breaking down exactly how she did it. The mindset shift that started it all. The unconventional moves most financial advisors won't tell you about. The sacrifices that actually paid off. And the ones that turned out to be a waste of time. If you're staring down student debt right now, and it feels impossible, stay with me, because by the end of this video, you'll have an actual blueprint, not just inspiration. Let's rewind. Maya graduated with a degree in marketing from a mid-sized state university. Nothing fancy, no Ivy League price tag. But between tuition, housing, and a study abroad semester, she was talked into by an advisor who probably meant well. She walked across that graduation stage, owing just over $80,000. The debt was split between federal subsidized loans, federal unsubsidized loans, and one private loan her parents had co-signed. Here's the part that makes her story relatable. Instead of sounding like some Instagram highlight reel, she didn't have a six-figure tech job waiting for her. Her first job out of college paid just $38,000 a year. On paper, the math looked brutal. Standard repayment plans would have stretched that debt over 10 years, sometimes even longer because of the private loan, and she would have paid tens of thousands of dollars in interest alone. So, how does someone making under $40,000 a year pay off $80,000 in under 4 years? The short answer is, she didn't do it on her salary alone, and she definitely didn't do it by cutting out lattes. Let's look at the strategy that actually changed everything. Every debt payoff story has a turning point, a moment, where someone stops floating along on autopilot and finally confronts the numbers. For Maya, that moment came about 8 months after graduation. She had been making the minimum payments, barely covering the interest. Then one evening, she opened an amortization calculator, just to see what would happen if she kept doing exactly what she was doing. The number staring back at her wasn't $80,000. It was closer to $130,000. Once years of accumulated interest were included, nearly $50,000 in interest alone. That number changed everything. She has said this was the moment she stopped thinking of her debt as just another monthly bill and started thinking of it as a fire that had to be put out as quickly as possible. That shift in mindset matters far more than most people realize. Minimum payments are designed around what's comfortable, not what's fast. The entire student loan system makes the path of least resistance the most expensive path. Once Maya started treating her debt as an emergency instead of background noise, every financial decision became easier to justify. Her entire strategy can be broken down into 4 simple pillars. None of them are secret hacks. None of them require winning the lottery, and every one of them can be adapted to almost any situation. The first pillar, aggressive budgeting, but not restrictive budgeting. Maya built what she called a reverse budget. Instead of starting with her expenses and seeing what was left for debt, she did the exact opposite. She started with a target loan payment, then built the rest of her budget around that number. She committed to paying $800 every month toward her student loans, a very aggressive goal, on a salary of just $38,000 a year. To make that possible, she moved back in with her parents for 18 months. She kept driving the car she had already paid off. Instead of buying a newer one, she planned her meals, instead of ordering takeout on impulse. But here's something important. She didn't eliminate every enjoyable thing from her life. Instead, she created what she called a joy budget. About $50 each month for coffee with friends, a movie ticket, or something small that made life feel normal. She understood that complete deprivation usually leads to burnout, and burnout often leads people to abandon their financial goals completely. The lesson wasn't suffer for 4 years. The lesson was build a budget that you can actually live with. The second pillar, was increasing her income. Not just cutting expenses. There's a limit to how much you can save. You can only cancel so many subscriptions. You can only skip buying coffee so many times. But there's virtually no limit to how much extra income you can create. Maya started freelancing. She offered marketing and social media management to small local businesses. She already had the skills, so she didn't need months of training before she could begin earning. Depending on the month, that side income brought in between $600 and $1,200 every single month, and she didn't stop there. She negotiated raises at her full-time job, not by simply asking for more money, but by documenting her results, researching market salaries, and proving the value she created. Over roughly 3 years, her annual income increased from $38,000 to more than $60,000, not because she got lucky, but because she treated her earning ability as something she could improve, not something she simply accepted. The third pillar was using the debt avalanche method. With one important twist, she continued making the minimum payments on every loan. Then, every extra dollar she earned went toward the loan with the highest interest rate. In Maya's case, that was her private student loan. By attacking the most expensive debt first, she reduced the amount of interest that could accumulate over time. But later, as her credit score improved and her income became more stable, she made another important decision. She refinanced a portion of her student loans into a new private loan with a lower fixed interest rate. Now, this is where it's important to slow down. Refinancing federal student loans into a private loan means giving up valuable federal protections, things like income-driven repayment plans, temporary deferment options, and potential loan forgiveness programs. Maya understood those trade-offs. She had already built a solid emergency fund, and she felt confident in the stability of her income. For her, it was a calculated decision, but she has also made it very clear that it is not the right choice for everyone. If you're considering refinancing, take the time to understand exactly what you're giving up, and if needed, talk with a qualified financial advisor before making a decision. Because once federal loans are refinanced, the process cannot be reversed. The fourth pillar was automation. It sounds simple, but Maya believes it was one of the biggest reasons she stayed consistent. Every time extra money arrived, a freelance payment, a tax refund, a birthday gift, a raise, or a bonus, she immediately scheduled an extra payment toward her student loans. Before that money ever felt like spending money, she removed temptation before temptation even had a chance. Behavioral finance research shows that automation almost always beats willpower, because willpower gets tired, systems don't. Maya never had to wake up each month and ask herself whether she should make an extra payment. That decision had already been made. All she had to do was leave the system running. Now let's talk about the sacrifices that were actually worth making. Moving back home for a year and a half wasn't easy. It meant giving up a level of independence most people in their 20s value deeply. She watched friends move into new apartments, travel, take vacations. While she was sleeping in her childhood bedroom, she continued driving an older car. Even when repairs became inconvenient, she skipped 2 destination weddings because the flights simply didn't fit her financial priorities. Many weekends were spent doing freelance work while friends were sleeping in or enjoying brunch together. None of these choices felt exciting. None of them were glamorous, but they were temporary, and more importantly, they were intentional. She wasn't punishing herself. She was making a short-term sacrifice for a long-term goal that mattered more. Of course, no debt payoff journey is perfectly smooth, and Maya has always been honest about the mistakes she made along the way. Early on, she tried following an extremely strict grocery budget. On paper, it looked perfect. In reality, She was constantly hungry, frustrated, and exhausted. After a while, she gave up on the entire plan. For almost 2 months, looking back, she says that experience taught her a simple lesson. A budget that isn't sustainable isn't really a good budget, no matter how impressive it looks. She also made another mistake. She joined a multi-level marketing side hustle. She hoped it would become an easy source of extra income. Instead, she spent a few $100s on starter kits and supplies and earned almost nothing. That experience changed how she evaluated every future opportunity. If a side hustle required paying money first before earning money, she walked away. Another lesson came from something she avoided. For a long time, she never contacted her loan servicer. She assumed there was nothing they could do. Then one day, a friend encouraged her to simply call and ask. That conversation helped her discover a short-term forbearance option during a particularly difficult month. She used it exactly once, not to avoid her debt, but to manage a temporary financial setback without falling behind. Sometimes, the best financial decision starts with asking a question. By the beginning of year 3, everything started changing. Her loan balance had fallen from $80,000 to less than $20,000. For the first time, momentum was finally working in her favor because the balance was smaller. Less interest accumulated each month, which meant more of every payment went toward the actual loan balance instead of disappearing into interest charges. She has described this stage as the moment when the process finally felt like it was speeding up instead of slowing her down. During her final year, she accepted an intensive freelance project. That single project added roughly $9,000 toward her student loans. Then came her annual work bonus, nearly $4,000. Many people would have celebrated with a vacation or a major purchase. Maya celebrated by sending every dollar to her loan balance. She saw bonuses as opportunities to buy back her future, not upgrade her lifestyle. Eventually, the remaining balance was just over $6,000. She combined money she had saved with one final freelance payment that arrived at exactly the right time. Then, on what seemed like an ordinary Tuesday morning, she logged into her banking app, and for the first time, the balance read 0. Imagine that moment, opening your banking app, expecting to see the same number that had followed you for years, and instead seeing 0. No more monthly payments, no more growing interest, no more wondering how long it would take. Just freedom. So, what would Maya tell someone who is just beginning their own debt payoff journey? Her advice is surprisingly simple. First, know your real number, not just how much you owe today. Find out how much you'll actually pay if you continue making only the minimum payments. Include the total interest, because that number often becomes the wake-up call. That changes everything. Second, take your income as seriously as your expenses. Cutting unnecessary spending absolutely helps, but there's a limit to how much you can save. There isn't the same limit on how much you can earn. Look for ways to use the skills you already have. A side project, freelancing, consulting, tutoring, anything that increases your income can dramatically speed up your debt payoff timeline. Third, if you're thinking about refinancing, take your time. A lower interest rate can save you a significant amount of money, but refinancing federal loans also means giving up valuable protections. Understand every trade-off. Read the details carefully, and if you're unsure, speak with a qualified financial advisor before making that decision. Don't rush a choice that cannot be undone. Fourth, automate as much as possible. Willpower is unreliable. Some days, you'll feel motivated. Other days, you won't. Automation removes that daily decision. When the payment happens automatically, progress continues, even when motivation disappears. And finally, this may be the most important lesson of all. Build small moments of joy into your plan. The people who successfully pay off large amounts of debt are not always the people who suffer the most. They're the people who create a system they can actually follow for years, because 4 years of disciplined, sustainable effort will almost always beat 4 years of constant misery that ends in burnout. Maya's story isn't magic, and it isn't luck. It's a combination of increasing income, following a disciplined budget, with enough breathing room to stay consistent, attacking the highest interest debt first, making smart, well-informed financial decisions, and automating the process. So temptation had very little chance to get in the way. Did it require sacrifice? Absolutely. Did she make mistakes? Yes, more than once. But every mistake became another lesson, and every lesson moved her one step closer to financial freedom. $80,000 paid off in under 4 years may sound impossible at first, but when you break it down, it becomes something else. A series of practical decisions, repeated month after month, year after year. That's what created her zero balance day. And those same principles can be adapted to almost any student loan journey. If Maya could leave you with one final thought, it would probably be this: don't focus on how far you still have to go. Focus on making the next good decision, then the next one, and then the one after that. Because financial freedom is rarely built in one giant leap. It's built one intentional step at a time. If this story resonated with you, share where you are in your own debt payoff journey down in the comments. I genuinely love to hear your story, and if you'd like a detailed comparison of the debt avalanche method versus the debt snowball method, or a complete guide to deciding whether refinancing makes sense for your situation, be sure to subscribe. We'll be covering exactly that in an upcoming video. Thank you so much for watching. Until next time, take care of your money, so one day your money can take care of you.